Good afternoon, everyone. My name is Trent Grissom. I'm Director of Business Development here at Waterfront, and I'd like to welcome everybody to Waterfront Separately Managed Account Review. I know we'll have folks that are joining the call as we go, and we have already muted the lines. And so if you need to get hold of us, please use the chat function, and you can get our attention with it. We'll be using the slideshow presentation. You can find that on our news and events page at waterfrontadvisors.com. And we appreciate questions. So as you have questions, please type those questions in the chat box, and we'll have a question and answer piece at the end of the presentation after Chris and Matt speak. Today, I'm joined by Chris Harrington, our Chief Investment Officer here at Waterfront, and Matt Hekman, Portfolio Manager at Waterfront. And at this time, I'd like to turn the meeting over to Chris.
Good afternoon, everyone. It's exciting times here at Waterfront. We have a lot to talk about today. Separately managed account strategies are really starting to take off at Waterfront. We hired Matt Hekman in November of last year, and we're really excited about the hire. Matt was with Waddell & Reed, the Ivy funds, for 18 years. He was the lead manager for 7 years on the Ivy Balance Fund, a fund that had over $3 billion in assets, and he has strong track records to boot. He has a lot of experience and a lot of talent. And he joins Waterfront in November and is going to be running 2 of our separately managed account strategies. So most of you are familiar with the 2 that I run, 2 opportunistic strategies. And we're going to discuss those first, but then we're going to hand it over to Matt, and he will give you the update on our two newest strategies.
And so you should see the presentation that's going to be on your screen as we share that. And then Chris will take it from here. Also, as a reminder too, we'll be having a recording of this meeting that we'll put on our news and events page as well.
All right, so starting off with the opportunistic strategies. And before I get into my strategies, I just want to say one thing about the strategies Matt is going to be running. He's going to be running a balanced and an equity strategy, largely consisting of high quality, large cap companies, good, solid companies that generate high return on invested capital. And it pairs up so well with the strategy I run. The strategy I run is focused more on small cap companies sometimes with good assets, but not necessarily the best run. And the 2 provide excellent diversification when paired together. So we have a really well thought out plan going forward for how we're going to run our separately managed account strategies. And starting with opportunistic strategies. Go to the next slide, please. Just to give everyone a quick reminder, we have what's referred to as opportunistic strategy and opportunistic equity. Why do we have 2 of them? Well, essentially the OE is a high octane version of the OS. Has a fewer number of holdings. There's a little more trading. No bonds, where the OS can have up to 20% bonds. The OS will use some funds for international allocations, all individual holdings. So it does have a riskier profile than the OS, and the reason for the required minimum differences is once you start getting into bond buying, it generally requires a larger account. It's a good year last year for the OS. Really, the strategy took off in the 4th quarter of last year. Really, the Pfizer 95% moment was really good for value stocks, and it continued into 2021, and so it was able to post a 39% return last year, which is it was a good return. It beat all the indices. Next, OE, as you recall, I just mentioned, is sort of a higher octane version of the OS, and so it should be expected to do a little better in up markets and a little worse in down markets, and it did do better last year, had an extra 10 points of return, 49% return for the OE last year. So what drove the solid returns? First thing you got to point to is that it was a good market. S&P 500 and the Russell 2000 value, 2 sort of diverging indices. One is small cap value, one is large cap growth. Both have returns a little over 28%. So that's established a really solid base. One thing I will point out though, those were the high watermark. Their emerging market stocks had a really poor year last year. And then EFA stocks, which are international developed markets, their returns were quite a bit less. So it was the US really took the cake last year in terms of returns. So obviously the returns were above the market. So what drove that was largely security selection. Sometimes in these good markets, some of these smaller companies, and a lot of money moving around. There can be M&A and special events type stuff that really creates a pop in a stock. I listed 3 here. Vonage got taken out by Ericsson, Verso, M&A event, private equity. There's a small Canadian company that has several divisions, but sold one of its divisions for a high price, so that led to an over 100% return. So I had a number of those that really helped out the returns. And then just broadly though, their earnings were really strong. Some of these companies had extreme earnings growth last year. And actually the multiple, the PE ratio for many of the companies came down, meaning that, you know, they head into the year, maybe you're trading at, for example, 15 times PE, the end of the year down to 12 or 11, but they're still able to have a good return because the earnings growth was so strong. So the market has been pulling down the multiple, which I like on a go-forward basis for some of these cyclical companies that had really strong earnings last year. But the earnings were so strong that even with the multiple compression, they still posted good returns. You see a lot of technology in the OE, over 20% allocation. Most people think high growth. And I run a value strategy, so this is largely value tech. I use the example Hewlett-Packard Enterprise as a large holding. They are often thought of as sort of an enterprise server company that's a dying business, that there's nothing there, there's no growth there. But there's a lot more to them than meets the eye. They really have a strong software portfolio. There's several different divisions. There's actually some special situation stuff that happens with them as well. They won a lawsuit versus Oracle that brought in a large sum of money, and they also have an asset in China that they can liquidate for a good chunk of money as well. So I really get granular with these companies and look at some of those hidden assets. And when you really start researching this company, there's a lot more than just enterprise server. And so it trades as no growth, but I believe there is growth ahead. That's one example of several technology companies. Materials and consumer cyclical, pretty high allocations. Those are companies that had great earnings in 2021, but of course, if the economy starts slowing, people get concerned about some of those types of companies, and they probably did have peak earnings in 2021, at least for a couple of years. But my expectation is that as these companies settle back into more normalcy post-COVID in 2022 and beyond, the earnings are going to be higher than what other investors are expecting. So there's a definite tilt towards those cyclical industries like consumer cyclical and materials. OS is largely similar. You still see a high allocation of materials. Financials is a little bit less. Materials is a little, technology is a little bit less. Financials is a little bit higher. Industrial a little bit higher. Just the holdings are largely the same, but there are some differences. So it creates some modest differences in allocation. So looking forward, when you think about what can drive stock returns in 2022? Well, you always have to think about the economy. Stocks can decouple from economic growth, but still they tend to follow what economic growth is. And so when you think about economic growth in 2022, I'm a little more pessimistic than most. I just see us looking at a big fiscal drag. When we think about the dollar amount of stimulus that people received in 2020 and 2021, and that was a large sum of money that helped to propel growth. That stimulus is no more. Perhaps the Build Back Better plan some parts of it come to fruition in 2022, but these just massive stimulus that the government put forth in years past is now no more. And that's a big drag. What's going to make up for that drag? Well, consumers are in pretty good shape. They have a healthy level of savings. Now, healthy savings doesn't necessarily translate into increased spending. It could, but it's not a guarantee. But consumers definitely have the wherewithal to keep the economy chugging along in 2022. I'm of the expectation that some of this inflation dynamics we're seeing in the market are going to cause a little bit of a pullback. Consumers are sort of retrenching a little from these high prices and just sort of pulling back. I view that as a drag. It remains to be seen. We know that for the fourth quarter GDP, consumer spending decelerated. It started off real strong in October, decelerated a little bit in November, and actually posted pretty weak numbers in December. And personal income, real personal income, which is inflation adjusted income, has been negative for the past 3 quarters. Because although wages are rising, they haven't been able to keep up with inflation. So that is a big time headwind that has my attention. In terms of supply chain dynamics, that's starting to improve. Omicron is causing a delay, but it won't cause a very large delay. The expectation there is supply is going to gradually improve and should get back to normal by the latter part of 2022. And demand patterns should move closer to pre-COVID levels. We had this surge in durables, at-home appliances, furniture, phones, TVs, that shot up to a much higher level than it had been historical, which makes sense with some of the changing behavior with COVID. We believe those demand patterns are going to shift back to more normal, not completely shift back, but move back to a little bit better balance between services and goods demand as the year progresses. And so that'll move inflation lower, supply chains improving should help inflation, and expectation is inflation will actually revert back to historical norms by the second half of 2022. So a very sort of long transitory period of high inflation, but a transitory one nonetheless is the expectation. The elephant in the room is always these days the Federal Reserve, just an incredible amount of stimulus they put forth in the previous couple of years. One could argue too much. I think that's a pretty safe argument. And now they need to unwind some of that. And when the Fed starts pulling liquidity out of the system by raising interest rates, it tends to lead to multiple compression, and multiple compression can happen in the stock market, also can happen in the housing market, but the price people are willing to pay compared to earnings in the stock market or income in the housing market, both of those can get hit when the Fed starts pulling liquidity from the system. So that's a big risk. The other big risk is the Fed is now tightening to stop inflation when near-term growth outlook is one of a slowing economy. So you're tightening into a slowing economy. So that definitely creates some risk for risky assets, which stocks are. Getting down to the more micro level, profit growth, the most important thing, the overall economic environment is important for stock prices, but profit growth is always the most important. And when you start thinking about dynamics that impact profit growth, supply chain challenges and high material prices are going to be with us again in early 2022, but they should subside by the latter part of 2022. We have a big problem with our labor force right now in the US, though. Several million jobs lost, a lot of early retirement, and a lot of women leaving for COVID-related childcare situations. There's definitely a path to get more people back in the labor force, but it looks like our labor force has some permanent impairment from COVID. And not only that, so obviously you want a larger labor pool to help grow the economy, but we have a big time skills mismatch in our labor force right now. And what that does, it creates productivity challenges. Companies love productivity, at least profit growth. When you start running into productivity challenges, then it can impact profit growth. Labor actually is pretty confident right now. They can extract wage gains, and obviously that is bad for profit growth. I think there's some unrealistic expectations on what tech spending will be in the upcoming years. The COVID pulled forward a lot of tech spending, and the growth rates have been really strong. We'll see what that settles into. It's still going to be a really strong growth market, but whether the growth rate is maybe a little bit less than people are expecting is sort of what to focus on. And competition heating up, that's enemy of all profits right there. We saw Netflix got hit pretty hard on earnings. We know that the streaming wars are heating up. Some of these growth areas, payments, PayPal, stocks getting hit quite a bit today. The payment space is getting more competitive. So some of these technology-oriented growth industries are actually starting to experience some competition. And as the economy slows, competition tends to pick up. Several big themes in the current allocation. As I mentioned earlier, high allocation of cyclical companies that have peak earnings in 2022. My expectation is the fall off will be less severe than others believe. Well, I put an example down there. I'm pretty true to discounted cash flow analysis and sort of the math of earnings. A lot of investors just want to see what's going to happen next quarter. Is it going to be better than the previous quarter? I don't necessarily focus on that, and I give this example below that mathematically a company that earnings fall off in upcoming years, but still are quite a bit better than other companies that trade at much higher earnings levels, is the better investment if two companies are to eventually settle into the same growth rate. There's definitely companies that are trading at peak earnings in 2021, but we'll have to just see how severe the fall off is in 2022. And avoiding companies that need the extremely high growth rates to sustain stock prices. Lastly, I think a secular exposure to clean energy is important for everyone's portfolio. It's going to be a theme that will be a growth theme for certainly the next decade and beyond. But looking for companies with more modest expectations, more modest growth expectations. Some of the companies in that space have very high stock prices, but no earnings, so they're dangerous investments. Heavy exposure to technology will continue, but once again, it's the sort of value type technology. But this is a secular growth industry, so I will continue to allocate. And I like international. So talk about European financials, some of the metrics there, and they're actually starting to execute pretty well, some of the European financials, and that they trade at a much larger discount to US ones than I think they should. And Japanese industrials, some Japanese industrials, I use that example, are very, very sophisticated, very strong prowess, and but the Japanese stocks tend to trade at a pretty big discount to US ones. So I think those are a couple of good places to be. Lastly, I like telecom. I think you can get a high stable dividend. That's a higher dividend in utilities or consumer staples, and I think it has properties similar to those industries. All right, with that, I'm going to hand it over to Matt. And once again, I just want to say how excited I am to have Matt joining us. We get to discuss various things in the market each day, and we have different viewpoints, and that's just fine. People can be successful in this business thinking differently about things, and but it's just good to have a talented individual to be able to discuss stocks in the markets with every day. I'll hand it over to Matt.
Great. Thanks, Chris. Thanks for the introduction. I'm delighted to be here. As Chris mentioned, there's definitely a lot of synergy that can happen between our two philosophies and processes that I think will benefit you all of our clients in the future. I have had the opportunity to meet several of you over the course of the last couple of months, and I'm excited to hopefully have the opportunity to meet many more in the months ahead. And yeah, I'm looking forward to working together with Chris and the rest of the team here at Waterfront to continue to produce the kind of investment performance that you've come to expect, and also the service level that these guys and gals deliver on a pretty consistent basis. So delighted to be here. With that, jump into the presentation. As Chris mentioned, I'll be managing two strategies, the Waterfront Balanced Fund and the Waterfront Equity Fund. If you want to go to the next slide. Have a little bit of a description of each of those there. The Balanced Fund is a blend of equity and fixed income. I'm committed to staying within 50 to 70% of the total portfolio invested in equity, never get above 70% or below 50, and 30 to 50% will be invested in fixed income. The objective of that strategy is capital appreciation with some current income. The track record is just over 7 years. As Chris mentioned, I previously was employed by Waddell & Reed, Ivy Investments, and I managed the Ivy Balanced Fund. Had been doing so since 2014. My last day at Waddell & Reed was November 15th, and I started with Waterfront on November 16th. So that track record extends just over 7 years. On November 16th, we also started a new strategy, which is called Waterfront Equity. That's 100% equity. It's a concentrated portfolio. The track record is short, obviously, and that is focused on capital appreciation. So we go to the next slide, please. So a little bit of a deeper dive on each of the strategies, starting with the Balanced Fund. Balanced Fund seeks to opportunistically allocate between asset classes, equity and fixed income, to provide a combination of capital appreciation and current income. It's a diversified portfolio across sectors, and security selection is governed by an emphasis on finding reasonably priced, profitable companies with sound capital structures. Within the equity sleeve in particular, the philosophy is built on the belief that above average profitability is an accurate measure of quality and that the market frequently underestimates its durability. And so we seek to exploit the opportunity or create alpha by opportunistically investing in those companies when, for one reason or another, they're attractively priced or out of favor. Generally speaking, the equity sleeve is going to be the majority of the total portfolio, with the remainder in the fixed income side of the portfolio. The fixed income sleeve is focused on capital preservation, as well as current income. And the core thesis within the fixed income sleeve is that fixed income investing is inherently asymmetric. In other words, you can lose a lot, but generally speaking, fixed income isn't an area where you're going to create a ton of value. And so we're focused on compounding modest returns and avoiding credit mistakes that can impair capital. Generally speaking, the fixed income sleeve is going to be managed as a diversifying asset within the overall balanced strategy construct. There will be times when the markets will create opportunity to invest more aggressively within that fixed income sleeve, and we will take advantage of that. Currently, credit spreads are relatively tight, and as a result, the positioning of the fixed income sleeve is relatively conservative. We will flex that when credit spreads blow out, and we will opportunistically add to credit, high yield credit, when the market creates opportunity. Again, now is not the time for that. Finally, the cash position is just a residual of the number of qualifying investments we find. And generally, it will be between 0 to 3% of total assets. There's a few details on allocation and characteristics of the portfolio as of calendar year end. You'll see that equity is near the top end of my band. It's at 67% as of December 31st, and that's reflective of my outlook for growth. We'll get into that a little bit in more detail in a couple of slides, but I've got a pretty optimistic outlook for both economic growth and market returns in 2022. Fixed income is about 32% with the remainder in cash, and there are a few characteristics of the equity sleeve mentioned there. Generally speaking, the weighted average market cap of the names in the equity sleeve are smaller. They trade at slightly less of a price earnings multiple. It lists the dividend yield and a 17% return on equity. For the fixed income sleeve, as I mentioned before, it's pretty conservatively positioned. So 60% of the fixed income sleeve is in treasuries, with the balance in investment grade corporates. The duration is just under 6 years, and it pays a nice coupon of just over 2%. Coupled with the dividend yield on the equity sleeve, gives the Waterfront balanced portfolio some current income. Go to the next slide, please. There's the Waterfront balanced performance since 2014, when I began managing the portfolio, versus the S&P, which is the benchmark for the equity sleeve, and the Bloomberg Barclays U.S. Government Credit Index, which is the benchmark for the fixed income sleeve. We've also included the Morningstar allocation category, median return, which is all portfolios in the market that are available that manage with an allocation range of 50 to 70% equity. You can see relative performance versus that group is pretty attractive. Next slide, please. So then diving into the Waterfront equity sleeve, Waterfront equity strategy. This is a 100% equity product. It's a concentrated portfolio. We're focused on capital appreciation with this strategy. Again, diversified across sectors, very similar philosophy and process, trying to find reasonably priced profitable securities. The cash position, again, will be roughly the same as within the balanced strategy, very modest cash position. As of December 31st, you can see the fund was more or less fully invested with 99% in equity. The weighted average market cap, valuation, and dividend yield, as well as the ROE, very similar to the equity sleeve of the balanced strategy. There's a lot of overlap in the names held. You'll see the beta of the portfolio, which is just a measure of volatility of a portfolio of assets versus a benchmark. So in this case, the beta of the Waterfront equity sleeve versus the S&P 500 is just over 1. So over a 12-month time period, the volatility of this portfolio ought to be very similar, maybe a little slightly more volatile than the S&P 500. I point you to the graph on the right-hand side of the slide, which shows the relative sector exposure of the equity sleeve versus the S&P 500. And it ought to be relatively obvious, or probably is relatively obvious to you, the portfolio is pretty meaningfully underweight technology, with a corresponding and roughly equal overweight to financials. And that's just reflective of the risk reward I see in the individual names in each of those sectors. There are a number of technology companies that are wonderful companies, but they trade at valuations that seem prohibitive to me, and in my mind are likely to result in less favorable performance of their equities in the future. The inverse is true in the financial sector. I find a number of really fantastic companies trading at very attractive valuations that I think have a pretty bright outlook for 2022. Lastly, would you, within the equity sleeve, have a factor tilt toward value and a slight underweight to growth? Go ahead and move to the next slide. There's the performance of the portfolio. As I mentioned previously, this portfolio just started November 16th, and it's performed slightly better than the S&P 500 since inception through December 31st. Next slide. So I'll close up with a brief overview of my 2022 outlook. I'm a big fan of the philosopher who also played baseball, Yogi Berra. And he made, I think, a prescient comment, which is it's tough to make predictions, especially about the future. But you have to have an outlook. And based on everything we know today, these are my best guesses. They're not meant to be point perfect estimates, but really meant to give some direction or perspective on how I'm thinking about the growth outlook and the outlook for risk assets in 2022. So I'm expecting GDP growth to decelerate from a rapid growth phase in 2021. I'm expecting somewhere around 3.5% to 4%. I do think earnings growth in the S&P 500 will decelerate again from a fantastic level in 2021, but be meaningfully positive. So 8 to 10%. I think the S&P 500, as one indicator of the market, is likely to have a positive year. I'm guesstimating approximately 7%. And you can see based on my earnings per share growth forecast that I am expecting some continued multiple compression, which Chris mentioned earlier in his talk. Finally, my estimate for the US 10-year Treasury yield on December 31st is approximately 2.5%. I'm expecting two 25 basis point rate increases by the Fed and some steepening in the yield curve that's inherent in my forecast of 2.5% as of December 31st, 2022. I would like to say there will be a lot more discussion on the outlook that Chris and I are looking forward to sharing with you on February 16th. It'll be helpful to be able to give a little more detail about what's behind my forecast and his, as well as give you some charts that will help you visually see and understand some of the dynamics that we think are important in the market. So tune in or plan to tune in on Wednesday, February 16th. We'd love to have that opportunity to have a further conversation with you on the 2022 outlook. But finally, to close, I want to point you back to our true north, or my true north. You have to have a forecast. We have to monitor macroeconomic forces and trends. But my emphasis, my focus, what I do day in and day out, is trying to find high quality, growing companies whose securities are trading at reasonable valuations with visible catalysts that we can identify to drive relative outperformance over the next 12 to 24 months, which is my investment time horizon. That approach has served investors well over time, and my confidence in it has not waned. So with that, I think we'll pause and I'll turn it back to you, Trent.
Perfect. Thank you for all that information, both of y'all. As we start opening things up for questions, one question I'll ask both of you, because obviously in looking at the two different portfolios, or really four different portfolios, but two different styles, some of the questions may come up, the top holdings that y'all have in your investment portfolios. And Chris, some of yours, folks may not be as aware of them. Matt, some of yours, they'd probably be more common names that they may be aware of. So I'll ask both of you this question. I'll start with Chris. What are some of your top holdings and why?
Well, on the industrial side, there's a company called Atlas Worldwide. They do freight transport, air freight transport, and they were a big beneficiary from the pandemic because the passenger airlines no longer transported cargo, at least the overseas routes. And so that shrunk capacity in the industry, and the prices for air freight shot up, and there was also strong goods demand from overseas. So it's been a really robust market. That company has taken this opportunity to lock in some long contracts at what I think are attractive rates. And so even when passenger air travel comes back, and there is a little more capacity to transport freight and prices come down, I think there's still a robust earnings profile there. So, I mean, that's a company trading at 4 times earnings. You know, they're obviously going to decelerate, but it remains to be seen. European bank, SocGen, has been a pretty big holding. They're executing well. They've always been perceived as a poor executor, but if you look at some of what they're doing, there's a path for them to execute well. They've been doing so. So that's a large holding. There's a copper miner in Canada that's a large holding. Copper's at a high price right now, so anyone mining copper is making a lot of money. Copper prices will probably go down, but there's some unique circumstances there that I like in that situation. Ally Financial is a U.S. company I like. Did a lot of financing in the car industry. There's a lot of others, Japanese industrials that I talked about earlier. I'll leave it at that, but Matt, talk about some of his.
Okay.
Yeah, I would say some of the names that I'm pretty excited about currently. One that's topical, Alphabet reported after the market closed yesterday, and stock's up today in trading, or it had been, or was up when we walked in here. I like companies that have dominant market positions, and Alphabet with their Google property has sort of become synonymous with search and advertising. It's a fabulously profitable company. It's a company that I think has a competitive position that is unassailable, frankly. And I think the outlook for search and advertising in general is phenomenally strong. The stock doesn't trade at an exorbitant multiple on earnings, and their cash flow is phenomenal. Another name I really like as a large weight in the portfolio is Microsoft. Again, similar kind of dominant position in software. That's a product you guys, I'm sure, use on an everyday basis. They had recently reported earnings, had another strong quarter, strong outlook for growth. Their cloud product is booming, and I expect it to continue to boom as companies look to move from an on-premise infrastructure to a cloud infrastructure. I think that trend is, at this point, well understood, but still probably 30 to 45% complete, which means there's a long runway for growth going forward. Both of those companies continue to innovate, come up with new products and new services and new monetization strategies that I think just lends belief or credence to the belief that the growth rates that they've been posting will be sustainable into the future.
Perfect. We do have a question that popped in. It said, who can use your managers? And so that's probably multi-pronged, I would think. If you could, both of you, will start with Chris again, but recap the minimum associated with each strategy. And then if there's a specific allocation, if they need to have a certain number of investable assets because they don't want to have too much of an allocation towards one, or if one is good at setting up a core or a base, or just kind of talk to the ideal client that would fit for the strategies.
Okay, well, we are big believers in diversification at Waterfront. It's not just cliche. So there is a minimum. It's 100,000 for the OE, 250,000 for the OS, but your investable assets need to be quite a bit above that. We will, in general, only allow 1/4 or maybe 1/3 of an investor's assets to go into one of the strategies. Because they target specific areas, there is some risk. So, if you look at the minimums, assume you probably need about 4 times that in investable assets to be able to invest in the strategies.
Yeah, and I would say for the Waterfront Balanced Fund, the minimum investment is $200,000. The Waterfront Balanced Fund is kind of a nice foundation, is the way I like to describe it, upon which you can build or add incrementally, either add more risk by adding more equity exposure, or add a little more diversification by adding more fixed income exposure or cash. But the balanced portfolio is generally considered to be a good foundation for your total portfolio as a whole. The Waterfront Equity Fund has a minimum investment of $150,000 and is a little bit riskier, but probably less volatile than Chris's pure equity portfolio, just given that they're higher market cap, a little more stable, bigger companies. But it definitely will be more volatile than the balanced fund.
Okay. And obviously y'all kind of talked a little bit about inflation, a lot of the different headwinds and tailwinds. And so y'all will cover more of that information in the outlook on February 16th, correct? We'll go in more detail on that.
Absolutely.
Okay. I don't see any other questions. Do we have any other questions online? Okay. I'd like to thank Chris and Matt for sharing this information today and for presenting to us. If you have additional questions or if you'd like more information on any of Waterfront separately managed accounts, you can email Trent at Waterfront Advisors. And a few reminders and a follow-up. The presentation is available on our news and events page. And then there'll also be a recording of this call as well. And then please plan to join us for our February 16th market update. That will be at noon Central on February 16th. This concludes our call for today, and thank you for joining us.
Thank you.
Thank you.